Hi, my name is Pratik Kala and I'm the head of research and portfolio manager at Apollo Crypto. Today I'd like to talk to you about MicroStrategy or strategy and the various range of instruments they're issuing to exclusively acquire Bitcoin. By way of comparison, Strategy now holds 72 billion US dollars worth of Bitcoin in their treasury. BHP Billiton, which is one of the largest mining companies in the world, has roughly about the same market cap. So it tells you the enormous scale of this operation and the intention to continue. For people who don't know what Strategy is, it was a company founded in 1989 by Michael Saylor, who is still the CEO today. It initially started offering a range of tech services, but suffered during the dot-com crash and struggled to find a footing since then. In about the 2010s, Michael Saylor, the CEO, discovered Bitcoin, and by 2020, the company completely pivoted its entire strategy to become a Bitcoin treasury company, the first of its kind. Since then, the company's sole focus is to acquire as much Bitcoin as aggressively as possible, and they do this using various instruments. Initially, they started using convertible debt, then they started using the at-the-market facility, and more recently, they started issuing a range of perpetual preferred equity to acquire more and more Bitcoin. Today, we'll double click on some of these perpetual preferred equities, the structure, the risks, and where to from here. For people listening in podcast format, you would need to watch this one as there's going to be a couple of graphs that will illustrate this better. The best analogy to explain what Saylor is doing is to look at existing instruments. Now, in the credit and fixed income markets, typically ratings such as AAA, B, C, or junk is provided. The further you go down the risk curve, or the worse the rating gets, the higher the yield investors demand. In this graph, you will see that as the maturity increases and as the ratings get worse, the yield required by investors is much higher. The difference between the yields is called the credit spread. So as you'll notice in this graph, the credit spread for AAA is between AAA and CCC is significant. Could be 200, 300, 400, 500 basis points or more depending on the market conditions. So what Saylor is doing is trying to replicate this in the Bitcoin world. He's issuing a range of perpetual preferred equity instruments backed by Bitcoin. So what is the difference between these instruments? Well, some of them have monthly dividends, some of them have quarterly dividends, some of them have cumulative dividends, some of them have non-cumulative dividends, and some of them have an embedded call option within the structure. So Saylor's issued a wide range of preferred equities with various term sheets to attract all types of fixed income and credit instruments, and his sole purpose is to sell these to acquire more Bitcoin. I draw your attention to this chart and the range of instruments that Michael Saylor has issued. You'll notice over here that he's issued 4 instruments so far. These are all perpetual in nature, which means they have no expiry date. He's issued STRC, called Stretch, the latest, STRD, called Stride, STRF, called Strife, and STRK, called Strike. A bit of a tongue twister across these ones. And you'll notice that he's comparing it to traditional finance instruments such as junk bonds, preferred stocks, and long-term US Treasury bonds. Today, we'll talk about STRC or Stretch, Saylor's latest offering, which has taken the world by storm. So what is this instrument? It is a perpetual preferred equity instrument which offers dividends on a monthly basis. Its value is supposed to be stable, right about $100, and right out of the gate, it is offering a 9.5 to 10% yield, which is significantly higher than the risk-free rate. As you can imagine, investors are incredibly interested in this product. 9.5 to 10% yield paid monthly, backed by, over-collateralized by more than 10 times the amount of Bitcoin, which is a deeply liquid, globally traded asset with more volumes than many of the Mag 7 stocks. A lot of investors want access to this instrument. So it begs the question, where is Saylor going with all of this? Well, Saylor wants to tap the fixed income and credit markets, and he's trying to issue completely new products backed by Bitcoin to tap into these markets. I draw your attention to this graph here. You'll notice that the instrument that Saylor has issued is only $500 million to start with, but the global short duration credit market is immense. I mean, the money market funds are $7.4 trillion, the treasury bills, bank accounts, and commercial corporate paper. Combined, these are well over $30 trillion that are getting a significantly lower yield, say 4 or 5%, compared to what Saylor is offering at the start. Now, of course, there are limits to how far Saylor can take this. I mean, there's 9.5, 10% dividends across a range of instruments. Where are the dividends going to come from? How does Saylor intend to pay for these? Bitcoin is a non-productive asset. There are no cash flows associated with it. So how is he going to pay for it? Well, he intends to use the at-the-market facility and dilute the common shareholders to pay for these. Now, you may think, why would the common shareholders want to continue holding the stock if Saylor is going to dilute them? Well, they believe in accretive dilution, which is a concept that Saylor has also championed, and a range of different digital asset treasury companies are championing. So over the long term, they expect Bitcoin's value to rise, and because MicroStrategy is such a dominant player in the market, they expect the share price to be supported. One final chart before we go towards the conclusion. You'll notice on this chart that we've got a range of instruments that Saylor has issued, and on the far right hand side, you'll notice that he's got high yield equivalent and investment grade equivalent. This is tying back to the start of the video when I mentioned in traditional credit markets and fixed income markets, you've got AAA, B, C rating and junk bonds. And this is effectively what Saylor is doing over here with these instruments. There are different seniorities and different rights for shareholders on each one of these instruments. Now, I also want to talk about the BTC rating over here. Now, this is something that Strategy and Michael Saylor as a company have created themselves. And effectively what that means is how much of that instrument is backed by or over collateralized by Bitcoin. So a BTC rating of 3x basically intends that as Stride will be issued and will always be over collateralized by 3x the amount of Bitcoin at fair market value, which means if Bitcoin in my bank account is $3 million, in this case, I can max only issue $1 million worth of Stride with a BTC rating of 3x. Now, right to the top, Strife has a BTC rating of 10x, which means I need $10 million of Bitcoin collateral in my account before I can issue more of that. One thing to notice is that you can issue, Saylor can issue as many of these because he's got at the market facilities for each of these instruments. So if they ever get mispriced in their opinion, they can trigger the at the market facility and issue more of these. And he has been doing it for the past previous quarters. All of this money that he's generating is to aggressively buy Bitcoin, and his target is to acquire 5% of all the Bitcoin in existence. All right, now onto my favorite part and the conclusion. If your head is hurting after listening to all of that, don't fret. It took me several weeks to digest all of this, and I can assure you there's a very small fraction of people out there, even professionals, that understand what Saylor is doing and how these instruments tie into the broader ecosystem and what the long-term vision and risks are. Now, of course, you've been watching, some questions might have popped up on your head. First one is, Saylor's got to blow up. This is risky. How is he issuing so much debt? Well, today, Saylor and MicroStrategy and Strategy have the debt they've issued is over collateralized by Bitcoin by 14 times, by a factor of 14 times. So he's got 14 times more Bitcoin in his treasury than the amount of debt he's issued. Bitcoin is a globally traded 24/7 pristine asset that has more volumes than 99% of the stocks that are traded on global equity markets. So the asset is pristine, it's there, and it's 14 times over collateralized. So you could argue that these instruments should actually be more superior than junk bonds or even CCC rated bonds. It's just that they're new, so they don't have a rating yet, but I think that's going to come around. At today's prices, Saylor has over 180 years of dividends that he can pay out using his existing Bitcoin stack. And even if Bitcoin's price was to drop by 75%, he would be able to pay these dividends for 26 years. So I don't see a risk of Saylor blowing up at this point in time with the amount of debt load that he has. Of course, if he goes crazy and issues 10 times this amount, then that will be a different story. But for now, that's not a problem. Now, the second question you may have is, why are common shareholders okay with this? Well, common shareholders believe in accretive dilution. They believe that what Saylor is doing is very surgical, it's very mechanical, and he is ultimately acquiring more and more Bitcoin, which is going to benefit the common shareholder. And so they are okay with this accretive dilution, short-term pain for long-term gain. Some also believe that there will be a sovereign put on Michael Saylor and strategy. As a company, the reason why is acquiring 5% of Bitcoin is almost an impossible task even for the most advanced economies in the world. And Saylor may get there, especially with the strategic Bitcoin reserve that the US government has done. And eventually, many other countries or sovereign wealth funds may realize, well, we're not going to be able to acquire that amount. What we can do is get exposure through MicroStrategy. So that's some of the reasons that common shareholders are okay with these accretive dilution. Now, next question would be, how long can this go on for, right? Well, it can go on for a long time. As long as Bitcoin's price is going up, the ratio that I mentioned, that the debt is over collateralized by a factor of 14. As Bitcoin's price goes up, it will be over collateralized by a factor of 20. And Saylor can issue more and bring it back down to 14 or bring it down and continue moving on as Bitcoin's price rises. Of course, when Bitcoin's price drops, the demand for these instruments will pause, but the intention and the target for Bitcoin is to go up and to the right from here for the next decade and beyond because of how demand and supply works for the asset. So this can go on for a long time as long as Bitcoin's price is going up. Now, what risks do I see? Of course, there's risk with everything. The biggest risk I see is a change in tax or corporate law or accounting law. So in the future, you never know, you may have unrealized capital gains. That puts this under pressure. There may be a change in the law saying unproductive assets such as Bitcoin and gold would have a different tax treatment. With the amount of debt that is in the market at the moment, sovereign debt, I think governments are going to get creative to tax asset holders, and unproductive assets may be in their crosshairs first. There could also be some accounting changes where you may or may not mark to market the value of Bitcoin. I mean, this has only been approved 2 years ago, but in a future government in 4, 6, 7 years, they could reverse it. We don't know. So that's probably one of the biggest risks I see that would unwind this rather large operation. The second risk is obviously just government decree. You go from Trump to a Democratic government and they hate everything he's done and they want to reverse some of his policies. And in their crosshairs are the entire crypto industry, which it was under Joe Biden and Kamala Harris in the past. So that may happen, but I think that's a problem for the future. And my final and favorite question is, why don't I just buy Bitcoin? If this is going on, and if Saylor's going to be all right for the next couple of years and he's going to issue so much debt and buy billions and billions of dollars of Bitcoin, why not to just buy a Bitcoin in an ETF wrapper and pay practically nothing if that's that's the bull case? Well, for that, we can discuss this in the next video, but now we've got treasury companies for various different assets. Today, we have BitMine Immersion and SharpLink doing this for Ethereum. We have one for Ethena, we have one for Hyperliquid, we have one for Binance token, we have one for the Telegram token, we also have one for the XRP token. So obviously Saylor's success has led to a whole bunch of copycats, and they're doing it across the entire crypto spectrum. The only difference is Bitcoin is $2+ trillion, and all of these other assets that the treasury companies are running for are way lower valuations, like $300, $400, $500 million. So any demand over there leads to a substantial lift in prices. And if you look at the last quarter, all of these other tokens, Ethereum, Hyperliquid, Ethena, Binance token have significantly outperformed Bitcoin. So why should you not buy a Bitcoin ETF? Sure, I mean, yes, but as the market is shifting, there are a lot of opportunities in the altcoin market as well. And of course, with the backdrop of various regulatory changes that support the broader alt ecosystem anyway, where they can now generate cash and distribute it back to token holders. So the entire space is developing. It's very exciting. And I hope this video has provided a lot of insight into what Saylor's doing as the largest digital asset treasury company. And in the next couple of videos, I will discuss what some of the other competitors are also doing as this ecosystem develops. At any time, if you're confused or would like to know more, feel free to reach out to us. Always happy for a chat or an in-person meet. Thank you, and I'll see you in the next one.